Hi, everyone. I'm Terence Vanderwood, co-host of Dollars with Cents radio show and podcast. Here is my fellow financial guru, Ela Lange.
Hey, welcome back, everyone, for another great episode of Dollars with Cents. Comprehensive financial planning is our passion. Helping people grow and protect their wealth is our mission. Contributing to your registered retirement savings plan is one of the most beneficial and efficient ways to both save for retirement and reduce your annual taxes. Since the beginning of the year, all of you guys know that Terence and I are dedicating our shows around this subject, RRSP contribution, to make sure that you all know what it's about, and we will continue to remind you. You've got 1 week to go. March 1st is the deadline for contributing to your RRSPs.
That's right. And you should consider your RRSPs as a tax-efficient way to pay for your future self. Many people don't take the time needed to consider their future age or what their future is going to look like. I find it always a good idea to reflect on it, what it would be like in 20 years or so. I often find inspiration by observing those people around me. It doesn't take but 5 minutes. How about let's give it a try right now. Look at a picture near you of someone who is, about 20 years older than you are. The picture is best if it's a real person. If you're at a coffee shop or on the bus, have a look on somebody who you think that you would look like in 20 years. And then if you're at your own place and you actually have the real example of your parents in front of you, you can look at them and see what you're going to look like in 20 to 30 years.
Yes, that's a great idea because statistically, if you are male, you have a good chance of living to the age of 83 years. And if you're female, you'll live until you are 87. That's the stats. If you are a married couple at age 65, then you'll live longer. That's special.
Statistically,
yeah. The point is, you'll get to an age of the person you're looking at. Look at yourself at that age. Our RRSP savings are for that person, and this strategy involves long-term investing.
So when we say resist dipping into your dollars, what we are referring to is to not take away from that person that you either have in front of you or have in your mind's eye. By doing stuff like drinking wine in the Okanagan.
Or skiing in Banff, or going on a kayaking tour of the Gulf Islands.
Yes, or trips to France and Australia. Yeah, that.
It's very important not to dismiss these goals and dreams as pipe dreams. This is very possibly a reality for you and can simply be built into your life right now with a great financial plan. That's what a financial planner is there for, to create a solid roadmap for you to make those dreams realities. And beyond that, our job is to help you through the times when, for example, the unexpected happens.
Yes, and it does happen. We all know that the only constant in our lives is the sun will rise and fall, and change will happen.
And change is good, but sometimes there is nothing to prevent you from accessing the investments in your RRSPs, with the exception of locked-in plans that you can't get to. But you should consider the consequences before dipping into your RRSP. First of all, withdrawals attract tax at your marginal tax rate, and tax withholding at the time of the withdrawal may be as low as 10%, but could be as high as 30%.
Yes, tax withholding is what the federal government does when you withdraw from your RRSPs. It holds back a percentage of your withdrawal so the federal government can apply it to your taxes owing for that current year. So if it is below $5,000, it is 10% that they hold back, and in this case, that makes it $500. If it is below $15,000, it is 20%, and in this case would be $3,000. In other words, if you wanted to withdraw from your RRSPs and you needed $15,000, you actually have to withdraw $18,000 in the scenario of the 20%. And it goes even more with the 30%, because if it is above $15,000, it is a 30% withholding tax, and in that case, it's $4,500. So if you needed $15,001, it would cost you close to $20,000 to have that $15,001. So you need to check with your tax advisor before you withdraw to determine how much more tax you'll have to pay when you file your tax return.
Secondly, the most important, you cannot restore the contribution room. The amount that you can contribute to an RRSP in your lifetime is limited. So a withdrawal erodes some of this potential. Your notice of assessment is essential for this. It's a great tool for this number because Canada Revenue Agency is tracking this type of thing for exactly this purpose. Special circumstances can help you access money in your RRSP without these consequences. The Home Buyers Plan and the Lifelong Learning Plan allow tax-free withdrawals with the ability to recontribute. However, even with these plans, there is no ability to replace the tax-deferred growth on the investment that was lost when they are withdrawn from your RRSP.
That's true. So the Home Buyers Plan, otherwise known as the HBP plan, is one where each individual can take up to $25,000 of their RRSP investments or RRSP savings and put them towards the down payment of their first home. So the advantage to this is that there is no withholding tax that's applied to it. So the full $25,000 goes towards the down payment. There is a stipulation of how to pay it back. You have to pay it back over the next 15 years by contributing to your RRSP of 1/15 of the amount that you borrowed. So if it was 25%, for example, and Ella's on her supercomputer right now,
$1,666 over 15 years.
That's right. So each, thank you, Ella, supercomputer Ella. So you will have to pay back $1,667 to your RRSP for every year for the next 15 years. If you don't, then what happens is that $1,667 gets added to your income for that year. Another detail around HBP is that you can have two people, so it's each individual on their first home. So if you're a couple that are buying your first home, both of you can contribute $25,000 towards giving you a $50,000 down payment. And then you can also look to the new initiative from the BC Liberals around up to $37,500 towards a down payment towards your first home as well. That is a interest-free loan for the first 5 years, and then after that, it gets rolled into your mortgage. But anyways, we're not talking about mortgages. We're talking about resisting the dip into your dollars. So the other one where you may want to consider regarding your RRSP contributions is called the Lifelong Learning Plan, or LLP. And this allows an individual to withdraw up to $10,000 to use towards education costs. And it also has the same type of stipulation where in order to pay it back, you have to do 1/10 of what you borrowed every year for the next 10 years. And if you do not do that, then it gets added on to your income for that year.
The other thing to remember, folks, is if you don't want to dip into your RRSPs and you've got savings in your tax-free savings account, this is the most tax-efficient way to take money to use towards whatever debt payments or emergency funds so that you resist dipping into your retired savings plan.
You should refer to our chart that's coming up on the screen right now about how much it can cost your future self when you do a lump sum RSP withdrawal. The chart in front of you illustrates the lost value of the RRSP based on a various lump sum RSP withdrawals. So as you can see, the resist the dip into your RSP, this is a case for avoiding the RSP withdrawals. So a lump sum withdrawal of $10,000 would be the lost value of your RSP after 20 years would be $32,000. Now, these are assuming that your money is in an RSP that is earning interest of 6% and compounded annually over 20 years. So again, if you have withdraw $10,000 from your RRSP, as per the chart, you have taken away from your future self. Remember that person you were thinking of a few minutes ago. You have taken away from that person $32,000. And as you can see, it goes all the way down by the charts to $100,000, which makes sense, would be $320,000 that you'd be taking away from your future self. This is the reason why a TFSA can be considered in addition to an RSP. You might be able to make tax-free withdrawals from your TFSA to meet short-term needs while leaving, as Ella said, leaving your RSP's assets intact. Also, your TFSA contribution room is increased by all amounts withdrawn in the preceding years. In other words, each individual has the capability of having $52,000 contributed to their TFSA for 2017. And let's say somebody does have $52,000 in their TFSA and they withdraw $24,000 today, they will not be able to put that $24,000 back into their TFSA until the beginning of next year, until January 1st, 2018. Then after that, the contribution room is restored.
Such a fantastic account. A tax-free savings account is so little used from what I hear from people, but we'll go into that into another episode. So you're well on your way to meeting your retirement goals. You've taken the steps needed to build a retirement plan, including setting up an RRSP. You're contributing to it on a regular basis. You're helping to secure funds for your retirement. Hopefully, after listening to this show, we've encouraged you to dream about what you'd like life to look like after you finish working. But what happens if an illness interrupts your plan today?
It's not a nice thing to think about, and some people consider an RSP as not only the key to retirement, but also a safety net for unexpected events. But what happens to this financial strategy if you become critically ill? A life-threatening illness can affect your family, your ability to work, as well as your future well beyond recovery. Remember, folks, your biggest asset that you have right now, it is not your house, it is not your car, it is not your the equity that you own in your home as much as you think it would be. Well, your biggest asset right now is your ability to work, for those of you who are still working. Ella, can you tell us what kind of illnesses are we talking about when we refer to critical illness?
So most insurance companies will cover the following 24 to 26 critical illnesses, anywhere between aortic surgery to a coma or life-threatening cancer, things like stroke, loss of limbs, kidney failure, heart attack, dementia, including Alzheimer's disease, and paralysis, Parkinson's. Yeah, quite the strong, heavy illnesses that would certainly break up a financial plan if you had to stop working for a year or 2 years to recover from these illnesses properly.
Yeah, so the top three of these are heart attack, stroke, and cancer. And the statistics around those are staggering. I saw one that I think paints the picture sort of the best when it comes to critical illness and how it can help. Everybody drives a car, right? You have a car?
Of course.
Do you pay insurance on your car?
Absolutely.
Of course. What do you think the chances are that you're going to get into a car accident?
I'd like to think zero, but with the BC drivers, I'm going to have to say it's going to be more than 50%, sadly.
What's wrong with BC drivers? No, we all know what's wrong with BC drivers. We're all we're responsible, but as soon as there's a little bit of rain or snow out there, then it all becomes very slick. Anyways, the statistics show that 1 in 1,600 people who have BC insurance will have a claim towards their insurance. So they'll have an accident that makes them have to have a claim. So that's 1,600, 1 in 1,600. So the statistics around critical illness being the top three, heart attack, stroke, and cancer, the statistics are 1 in 4. 1 in 4. So if you're driving around in your car, there's a 1 in 1,600 chance that you're going to get into an accident. And if you look around you and you've got 4 people surrounding you, one of those people will suffer from a heart attack, from a stroke, or from cancer, which is sobering to say the least. But what also is again, the great benefit to having critical illness is that the survivability of these diseases is increasing more rapidly and is more likely of a chance that you'll survive. But that still doesn't mean, even if you say you get a heart attack and you have to take it easy for the next 6 months, you survive, which is great, but you still got to worry about work. How does the payout on a critical illness policy work?
Critical illness pays out in one lump sum, tax-free. So you receive a tax-free lump sum benefit after satisfying the waiting period if you're diagnosed with one of 24 or 26 critical illnesses, depending on the company. This allows you to use that money to go for a recovery period or treatment in the United States. You can do whatever you want with this money. You can stay at home and recover while you hire someone to look after the daily activities that you can't attend to. If the kids are going to school and certainly need someone at home to make sure that the meals are done and the house is clean, well, now you've got that money to make sure that everything is looked after, and you can concentrate on getting better. And as Terence said, with the way health is today, or healthcare is today, we have all that more chance of recovering from a critical illness with that type of financial assistance.
Yes, definitely. So let's bring the two worlds together, our RRSP contributions and a critical illness policy, and we'll sort of paint a picture for you, if you will. So let's say I have $50,000 invested into an RRSP, and I contribute $500 per month for 25 years. Say that now I expect to retire with $360,000. That's a 3.5%, a conservative rate, by the way. Usually we say a reasonable rate of return is double that, 7%. But that makes me happy because I'm a conservative investor and I like to make sure that I can sleep at night. So what the 4 scenarios that I might experience are as follows. 1, if I may live a healthy life without any insurance, and what we retire on are the original savings of the $360,000.
Second is I may live a healthy life with critical illness insurance and even arrange to have a return of premiums. That's something that's also very interesting. So that after a certain amount of years, I retire with close to my original savings. I may get sick at some point, but as I have insurance, I have the money to pay for my recovery and I can retire comfortably because I haven't dipped into my RSPs. Or I get sick, I have no insurance, and I retire with a substantially less amount of money in my RSPs, or nothing at all, depending on how bad it was, because I've had to dip into my registered retirement savings plan. I'm losing out on my taxes. I may even have to delay my retirement as I'll have to replenish my savings. Not fun at all.
No, not at all. 25 years of retirement savings could quickly disappear in 1 to 2 years. Medical costs are astounding. And how would you get to your retirement plan back on track? Well, you could retire with less and change your retirement plans. You could work longer and retire later, but that's a real drag, right? I think I'd rather have the safety net.
So we mentioned a very special term there called return of premiums, and that's really a very interesting feature. If we say like the scenario, the first scenario where I live my life healthily and I'm not sick, I don't get ill, and I'm close to retirement, if I've chosen to have that return of premium rider, then I receive a portion of my premiums back after a certain amount of time. And then after the critical illness policy has expired, and I, again, haven't dipped into the policy, hadn't gotten sick, and everything's still there, I can have all of my premiums reimbursed. So something to think about, and definitely talk to your advisor about when setting up a critical illness policy. Those are features that are adjustable according to your cash flow, your budget, and desired needs. If you believe that you may have or suffer from a critical illness in the future, if you have families members who you've seen devastated by an illness, don't think twice. Call us and find out how you can also set up an amazing critical illness plan for yourself.
Yes, because essentially once you do have critical illness, and if you do get one of the 26 diseases and survive for 30 days, then you get a lump sum amount of cash, which you can use for anything. You can use for a trip if you want. If you have a terminal disease, you could use for getting the best doctor support that you can. You can use it to help pay for the mortgage payments for the next 2 years while you're recovering. You can have your spouse not work so that you have somebody by your side as you're recovering. There's so many things that you can do with it. And above and beyond that, it also protects your RRSPs. So you do have a retirement income that does not interrupt the plan, the financial plan that you've put forward of retiring at a certain age with a certain amount of money. So remember, applying for a critical illness is easy to do. Premiums can fit your personal budgets, but factors such as age and smoking status can affect the cost of premiums. But this should not discourage you from understanding how insurance can fit within your retirement plan. Any amount of insurance is better than nothing. The last thing you want to do if you are dealing with an illness is worry about money.
That's right. You can even take part of your regular RRSP contributions and purchase critical illness insurance. If you find that budget flow or cash flow is a bit tight, well, it's just protecting your RRSPs. You are thinking about your retirement savings plan by investing in a critical illness policy. This is basically creating a backup plan that helps protect your retirement but doesn't restrict your budget or lifestyle. It's worth protecting, folks. That's a safety net that's right there for you.
That's right, because growing and protecting your wealth, that is your financial planner's job. And that's our job, and that's what we do with our clients. So your action item for this week is to reach out to your financial planner and ask them about critical illness. If you do not have an existing critical illness policy on you, then you should take the steps to make sure that happens. If you do not have a great financial planner, then please feel free to reach out to us, and we can certainly help you out with that. There's 4 ways that you can get a hold of us. One is by email at twofinancialgurus@gmail.com. That's twofinancialgurus@gmail.com. We also have, you can reach us by phone at 778-879-0820. You can leave us a comment if you want on our Facebook page at Dollars with Cents. We have all our episodes are up there. And then the final way is by going to YouTube, where we have over 39 different episodes for you to choose from. Just go to the YouTube search bar, type in Ela and Terence, and we will pop up at the top there, and you can choose whichever episode is the one that is you have the questions about. Please feel free to subscribe while you're there, and also you can leave us a comment if you want us to get a contact with you, or you just like the show and you want to give us your feedback. Please feel free. We're always happy to get your responses and your feedback from you.
So last reminder, folks, 1 week to go until the March 1st deadline to contribute to your RRSPs. If you have any questions about any of the episodes we've discussed RRSPs, don't hesitate. Call us out, email, or send us a comment. By all means, make sure if the RRSP is for you, let us help you. Thank you for tuning in today and joining us on this episode of Dollars with Cents. We hope you found it useful, and we look forward to seeing you back here next week for another knowledgeable, packed episode. Until then, Terence and I wish you a productive week, and
may your dollars and cents be with you.